I'm Motley Fool Canada senior analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing the big tech sell off that's led June 2026 and wiped about $1 trillion of valuation off the market in a single day to start the month. And we'll talk about the lessons that every investor should be taking from that volatility. My guest today is Iain Butler, the Chief Investment Officer for Motley Fool Canada. Iain, thanks for joining me today.
Super to be here, Nick. It's been a couple weeks, so good to be back.
So, Iain, the NASDAQ went from a record high to its worst day in over a year in the span of a single week to start June. Walk us through what happened and why chip stocks got hit so hard.
Yeah, indeed. North American stock markets in general were not kind last Friday, and the tech-heavy Nasdaq was especially mean. The thing is, though, all things semiconductor, which is sort of a synonym for chip stocks, they'd really been on a straight run to record highs in previous weeks. To start June, the Dow, S&P 500, Nasdaq, and the Canadian market all closed at or near all-time highs, and especially the U.S. markets. This is purely led by AI and semiconductor stocks. So what's happened is that after a 3-year bull market, really for that group, those highs are a result of a relative handful of companies. So the indices were and still are, and I think this is a real risk that's out there, still are carrying real concentration risk. So to last week's specifically, what triggered the decline was a soft outlook from one of the select companies that has driven these markets higher, Broadcom, plus some macro news, a hot U.S. employment number. So Broadcom reported on June 3rd with about US $22.2 billion in revenue, but it did not raise its AI chip outlook, and that sent sort of a shockwave through the whole group. And then May U.S. payrolls came in at 172,000 against an 80,000 forecast, and this pushed up treasury yields. And what tends to happen is that high multiple growth stocks fall when bond yields rise. And maybe this goes beyond the scope of the 5 Minute Major, but just quickly, in theory, stock prices are based on the discounted value of a company's future cash flows. So bond yields serve as a base for this calculation. Higher bond yields mean those future cash flows are worth less.
Yeah, so you talk about, okay, one company's earnings report, one jobs report leads to $1 trillion in valuation being erased from the market in a single day of trading. What are the lessons for stock market participants, from this volatility? What should Canadian investors do with this information?
For sure. So I mean, again, things were on such a run. I think you just read this as a valuation reset of sorts. I wouldn't say anything's particularly cheap in that world, but it's cheaper. But in terms of business fundamentals, nothing broke here. The selling was profit taking. Prices ran ahead of earnings. Chips then had bounced back earlier this week, with many of the hard hit companies performing well. And I think just goes to show that this was more a sentiment move, as opposed to underlying business characteristics. This said, let's go back to those market concentration comments from earlier. So even if you don't look at your portfolio, and even if you don't own a single chip stock and think you're diversified, many Canadian investors hold these high-flying names through index funds and U.S. tech ETFs. So the concentration is already in your portfolio, even if you don't own one specifically. So I'd highly recommend checking to see how much of your index ETFs sit in just 5 or 6 companies. You might be alarmed because I think the S&P 500 alone is about 40% in 5 or 6 companies. This said, volatility in general is the friend of the long-term investor, and for we long-term investors, it's what we should embrace as opposed to fear it. So the strategy is just decide in advance, put together a list of companies that you would buy if they should fall another 15 to 20%, have some cash on hand, and let market noise hand you the entry points.
Yeah, that's right. So don't view market volatility as a risk. View it as an opportunity. The longer you spend in the market, the more opportunity you have to take advantages of these downswings to be expected, to see some volatility after the really strong run we've seen from chip stocks in the tech sector so far in 2026. But the promise of AI is that we may see even more growth to come. We'll be talking about that on future editions on the 5 Minute Major, I'm sure. But that's all the time we have for this edition of the 5 Minute Major. Reminder, as always, if you want more stock ideas from us, you can click on the icon in the upper right corner of your video screen. Thanks so much for spending your time with us, and we hope to see you next time. Fool on.